Good morning.
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 Call to order the July 18th Police Pension and Relief Fund Board meeting. We'll dispense with the roll call. A quorum is duly noted. Media was notified. First item on our agenda is a report from our board financial consultant.
Thank you, Mr. Chairman. This is our quarterly review. We do have a couple numbers that won't go in to the performance number until next month, namely PRISA, which I'll give you a little bit of an idea of what they've done, as well as the Goldman Commodities Opportunity Fund, and Bo may have a few words on that as well as a snapshot on performance. But those two numbers are not embedded in our end of June 30th number. We closed the books, top right-hand corner, $42,672,000. With a little accrued interest, brought it up to 42.6 for the month of June, which I think when we were here for our May report, we gave you a little bit of a snapshot of what was going on. We've kind of gone full circle from the end of May, the last week of May, to current. We have seen quite a bit of volatility, which we talked a little about in our May review. As sometimes we say in this business, sometimes the best move is no move, or very little move, and we kind of held to our strategic strategy from a standpoint of looking at this more long-term than short-term and not getting caught up in a tactical decision. So we remained pretty much balanced. We did sell out at the end of June our PIMCO Real Return Fund, which ended up being a good move, and we kept that on the sidelines. If you look at the June performance number, we were down 85 basis points versus the blend of 72 basis points. What really I looked at was from a standpoint, and Bo and Larry and I kind of did some adjustments on this, but we really factored in on the mutual fund segment. If you look at, for the month of June, we were down 1.33%. We understood while the equity section was down, because the overall equity market was down, as you can see, Wilshire and the S&P. But the mutual fund sector, of that mutual fund sector, 70% of those positions are highly interest rate sensitive. And you know what happened in the month of June and the first part of July was interest rates went up dramatically. We saw basically 0.75%, and since the lows in May, more than 1% move on the 10-year, which in that short period of time is very dramatic. So what we're going to try to do is soften that going forward, and we've got a couple recommendations today. Obviously, we already put one of those in place at the end of June with the PIMCO Real Return, and we're going to talk about the total return, low duration a little bit, and try to soften that, because I think what happened, and of course we can talk about the Fed all day long, including the analysis of Chairman Bernanke's eyebrows yesterday. I guess that's where we've gone to. We're now looking at his eyebrows. That was kind of an hilarious statement by some of the people watching him speak yesterday. The House Banking Committee today he speaks to the Senate Banking Committee. But overall, we're going to try to make some changes that will soften this, because it gave us a window to look at what happens to the portfolio when you see interest rates increase that dramatically as an effect on the equity market, but more so on the fixed income sector. Second quarter, we closed the books up 22 basis points. It may not sound like a lot, but with all the volatility, we were pretty pleased there. Versus 52, we did trail the index a little bit. Year to date through June 30th, up 5.27%. At the end of May, we were up 6.17. As of June 11th, we were up 5.62. And I can tell you, as of last night's close, we're up 7.52. So I think that really is what we're most proud of, is that we stuck to our guns and held tight with the overall strategy of the portfolio and within your investment policy based on the equity exposure and the positions we had in fixed income. So we're pretty pleased right now. Obviously, with Bernanke speaking, anything can change, but he's become very much more dovish in his comments over the last 24, 36 hours than he was back in June. You can see since annualized return 6.88 versus the blend 5.12. We did not have a drop balance. I did talk to Kathy this morning. I think they're doing some work in IT on some tests. I can tell you though, last month's was $19,845,000. I think we're probably within under 100,000 of that, Kathy. So really no change there, but we don't have an exact balance on the drop balance as of. So that gives you kind of a snapshot there. Our cash, while it was reported 630 at 8.34%, we're now at roughly 7.21%. There may be some things that the three of us will talk about to try to put that cash to earn a little bit of return without having principal volatility. So we're going to be looking at that over the next week or so, and once Bernanke finishes up today. Also, if you'll turn over one more page from the position page, which would be the second page of the positions, you'll see mutual fund section. We're going to add the Goldman Sachs High Quality Floating Rate Fund here, which is kind of the little brother to our other floating rate fund. A lot less volatility in its principal fluctuation. It pays about 0.5%. It's been very stable through this period of time where interest rates have moved, and we're just trying to take some risk off the table as it relates to interest rate risk. And basically what we're going to do is take money out of the PIMCO Low Duration Fund, roughly 2%, and we're currently at 5.58% as of this report, so we'll bring that down to 3%. And PIMCO Total Return, which has really been the most volatile piece of our fixed income exposure, which is 5.73%, we're going to take roughly 3% off the table. So what we're doing is effectively trying to lower the risk on the fixed income side with all the volatility. And again, we've had a little bit of a preview of what happens, not when the Fed takes measures, but when the Fed just talks about taking measures. And I think that probably is going to help us down the road, obviously, if they do start tightening up on QE, on quantitative easing. So those are the two areas. On the Goldman Sachs Commodities Opportunity Fund, I think we were down about 50 basis points for the month.
Correct.
In June, that is not built into this number. On the PRISA fund, we're up 3.46% for the quarter. Very nice return. Came in a little bit above what they projected for the second quarter. I'd still say they're fairly bullish based on what they're seeing for the next upcoming quarter. So I think that will improve this number a little bit. Obviously, we have twice the exposure, I guess, to PRISA than we do to the commodities fund. Let's go over to the pie chart page, which is right before Roman numeral 1 on your tabs. You can see 43.17% on the equity exposure. Our other, which is PRISA, Capital Point, and the Goldman Commodities Opportunity Fund, we're right at 20. I think if we looked at today, we've come down a little bit because of the increased appreciation on the equity side since the end of June. Our fixed, when you add up cash separate in the fixed mutual funds, roughly is a little bit more than 37%. That will not change. Remember, what we're doing on the changes, the selling the PIMCO funds into the Goldman fund, that'll keep our allocation to fixed the same. We're not moving more into equity at this point in time. Our growth to value will remain the same, 15 to about 11%. Then, of course, we have the large cap blend and international. I think the other good thing that we did do on this is that we didn't get over allocated to emerging markets on the equity side. It's been brutal. Came back a little bit here in the last couple of weeks, but you're looking at maybe 9-10% returns year to date in emerging market equity. So earlier in the year when we brought that down, when everybody was really proposing the emerging markets to be very, very positive, but obviously that has not taken hold, and most of that issue has been within China. Let's go to Roman numeral 1 behind that, and you'll see our performance and index comparison. At the top, the fixed income year to date, anywhere from BlackRock, which by the way has done a very good job on their low duration fund. We're not taking from that low duration fund. They're now down less than 30 basis points for the year. PIMCO Low Duration and PIMCO Total Return, the two funds that we're drawing down on, have been under they've had a lot of outflows too, but their performance has lagged, both versus index and peer group. So that's why we're taking from that and lowering the risk category. If you look down in the equity section, these numbers were at the end of June. You can see the S&P 100 all the way down to our Vanguard REIT. Most of these numbers have increased by 6 to 7 percentage points since end of June. So we've had that snapback rally on the equity side as the Fed and those spokespersons for the Fed have come out and become very much more dovish about quantitative easing. They basically kind of blinked and now pulled back and say we're going to keep this in effect until we see better numbers both on unemployment, on inflation, and overall economic conditions. So by and large, our managers have all done a good job. One of the things that we always look at is, when we did not take measures when the equity market was selling off, what did other active managers do? And for the most part, most of them stayed the course. And that's why they're still competing well with their indexes. You did not see them selling into that market. They held the course because they felt like it was, and I think Larry was the one in the last meeting that said, we feel like this is way overdone. And it looks to be that way at this point in time, not to say that we won't visit this trek a couple more times. So with that, that's kind of the report. Obviously, you have the more detailed information on Prissa. You can go into their highlights until I get their final return. As I mentioned, up 3.36 for the quarter, but a very good quarter for them. And they continue to probably be on target to be up maybe in double digits this year, by the end of the year, if things hold true. Bo, Larry?
Yeah, I would.
I was just going to tell you, as Alex just said, I mean, almost all the market move in the last 90 days has been driven by the Fed. I mean, really, earnings are important, but the Fed's what's driving it because it's kind of an interesting component. If you think about this, quantitative easing has been driving the stock market. If they continue quantitative easing, it appears the market likes it, wants to rally. If they stop quantitative easing, then the market doesn't like it, it's probably going to go down. The only reason they would stop quantitative easing is because the economy is improving as a whole. So it's a little bit of a paradox. Also, I'll tell you, Bernanke, while he leads, and as Alex said, they watch his every move, he's going to be replaced. And so it's just a matter of time before the market stops listening to him. And there are other members on the Fed who disagree with him and believe that he's been too bold and too aggressive as it relates to lowering rates. And so the measures you see Alex referencing here are really positioning you so that if rates go higher, you're going to have less of an impact on your portfolio. You see, because the inverse relationship between bond rates and interest rates, or bond values and interest rates, as rates jump up like they just did, you see a pretty dramatic change in bond prices. There are certain kinds of bond funds that float, and if they float up as rates go up, and that means that they're more dampened as the rates, if they start to drop. And so all I'm telling you is that we're taking a more defensive posture. Most analysts still forecast year-end results are going to be stronger. Earnings are getting stronger. Unemployment is improving slightly. Consumer confidence is improving. Value of home prices are improving. Big ticket items for consumer spending is improving. And then, Harris, I know you're sensitive to this, but gold's always been kind of one of your favorites. There's a scenario out there where disinflation's occurring and commodity prices are going to continue to drop. I wonder how much of that's driving that, or how much of that's occurring really because China is starting to slow. And they're the biggest user of commodities. As we talked about before, gold is one of those commodities that doesn't have a industrial application. And so it's really driven more about inflation fear or about confidence, etc. And so we've seen that drop some here, but you let inflation come back and you may actually see gold start to rally again.
Larry, my question would be, I guess, in terms of quantitative easing, isn't it much like a medication you give a person? If you give them the right amount, it has the right effect and tends to make them well and feel better, but if you give them too much, it kills them.
Yes, sir.
At what point, obviously they can't endlessly inflate the economy. At what point does it turn, you think, and start having the adverse effect?
Ferris, we don't know the answer, nor does the street. It's like saying, how much debt can our country assume before it becomes all-consuming? And we don't know where that threshold is. I'll just tell you, this country is a beneficiary of a low interest rate environment. Most of us in this room remember back in the latter part of the 70s when short-term rates were at 16 or 18%. We're at less than 1%. The Fed's really been able to issue a lot of debt on a very cheap rate. They really can't afford for rates to go up either because their cost of funds go up. So it's still a pretty dicey situation. And what's supposed to happen, and if you read about the Fed, is they're supposed to be a catalyst to stimulate the economy when it gets tough and pull back when it gets soft. But we're not supposed to live and die by every meeting that the Fed has. And these have been unprecedented measures have been taken. A lot of them needed to be taken in light of what happened in the financial crisis in 2008. But we probably a time for us to wean us from them from that platform. Let us live and die by the free market that we all operate and work within. Otherwise, all we do is read financial reports and do what they say Fed's going to do. You rely on that. we've really moved away from earnings, a lot of the other variables that we ought to be looking at, because we've become dependent on what the Fed thinks. So,
Commodity-wise, we're really tie back to what these gentlemen have already said in inflation. It's a difficult environment when you have rising interest rates with zero inflation. When you have rising interest rates with inflation accompanied, you get some appreciation through some other asset classes along with that. Having this type of rate move that we've had being unprecedented, as both of them pointed out, was pretty negative to the fixed income classes. The aggregate index was down year to date 244 for the same time period, which 70% of the aggregate index is government or government obligations. So a difficult time all the way around for any type of fixed income indice. We thought if we got some type of pullback in the equity market, it might pave the way for some higher highs, and it has paved that way. The one thing that's continued to lag, and that is again going back to some really what looks like could be some deflationary pressures, is the commodity asset classes. The Goldman was down about, this is preliminary numbers, about down 2% for the year. To kind of give you some color of what some of the other commodities are doing, the Dow Jones UBS Commodity Index is down about 10.5% for the year. If you really break it out, every subcategory of the commodity indices are down, with industrial metals down 17%, precious metals down 30%. There's only 3 items out of all the commodity indices that are up, and that's WTI crude, which just turned positive recently, and then soybeans and cotton. So it's very difficult in the commodity asset class. When you take it in perspective that they're outpacing an index by 800 basis points, they're certainly doing their job. It's just a difficult market in the commodity space right now.
that's it for us.
Okay, any further questions? Thank you all.
Thank you.
Next on the agenda is approval of June meeting minutes. It's been moved, probably seconded to approve the June meeting minutes. All those in favor, signify by aye. Opposed? Motion carried. Report from the city attorney's office.
I don't have anything new to report. I just follow up on the FOI request that we discussed in the last meeting. I sent the reports over that for the last 2 months that we had discussed, and she called and confirmed that she received them, but she hasn't requested any board coverage.
Who requested?
The Democrat Gazette requested copies of all of our, a list of all of our assets that, I didn't bring a copy of it with me, but a list of all the assets that the police funded, fire fund had invested in from back to like 2002, and the individual return on each. But we don't actually maintain those documents, but because we have these monthly financial reports that are provided, that does list the assets that we're invested in. I provided copies of those for 2 months to see if that's what she wanted, and let her know what the cost would be if she wanted to go back for, 11 years. And she hasn't responded back if she wanted any additional information.
That was requested both of police and fire, and I think it was at the fire pension meeting that we had talked about it last time. I don't know if
we're
we
not
had talked
discussing,
about it
okay.
here.
Oh,
That's what
sorry.
it
I think we got it right
We got
after
it
this
after.
meeting.
Oh,
Yeah.
well, then I'll fill you in. We received a FOI request, sorry about that, I had my words mixed up. And, I didn't bring a copy with me because I thought we had discussed it, but she, from the Democrat Gazette, she just asked for a copy of a list of all the, assets that the, investments that this fund had made, with the individual return on investment for each one, back to 2002. But we don't maintain those records, we don't have a list, that provides the information. But we do have these financial reports that we provide monthly, but because that would be a lot of photocopying, and she wanted me to let her know if anything was gonna cost more than, $25. So, I sort of estimated how much it would cost to copy these reports that we have back that far, and, send her 2 months, or send her a report, 2 reports for each board back to April, I think. Stephen's report and then the report that Sarah prepares, and provided that to her. And she confirmed that she received it, but she hasn't requested any more.
What is the name of the report requesting this?
Azu, Misa, Azu, it's not one that I recognize, I was familiar with. But it says she does the police report. Do what?
She's attended this meeting before.
Oh, has she? Okay. So it's still there, if she, when she looks at it, if it's some information she requested, we'll provide it, if not, then, well, yeah. And that's all I have.
Okay, and next on the agenda is report from the board, Barbara Lobbyist, I don't see.
Yeah, Mr. Chairman, the last time I talked to Roger was just a few days following a past meeting. And actually I talked to him about what is listed as 6A on the agenda, which is the annual firearms qualification changes in the recent statute passed the legislature. There's some questions regarding unresolved issues, I might say, regarding fingerprinting and other new language in that statute that was a bit troubling, and we quite frankly didn't know how it was going to be handled. So he indicated to me that he has been in touch with the governor's liaison, and that it appears that there's going to be an assumption that retired officers' fingerprints are indeed already on file and so forth. But long story short is he's going to follow up and provide additional information at the August meeting. He did say about 3 weeks ago that he would not be able to attend this meeting, but we will have information forthcoming to the members, and there are some that's obviously concerned and interested in this issue.
Okay. Next item is report on funding committee.
Okay, we did not meet this morning, but we're going to meet in this session.
I understand, well, David's here, and I understand his copies of the report that I requested, I have not received as of this morning. So I want, in all fairness, this is the first time I've received it. I confirmed in my office that we have not received any certified mail at this point. This is something that we did not charge to the fund. It's something that I requested of David. And so if you would like to go over it, I think that'd be appropriate.
Certainly. This packet that we just handed out has a cover letter of July 12, and what this is, Mr. Moore had requested an additional COLA scenario for the police pension fund, and that additional scenario was a COLA of 2.25%. And so,
let me if I could just say something by looking. First of all, it was not addressed to me; it was addressed to Sarah.
Yeah, I just saw that.
And Sarah's office is on the 2nd floor, not the 3rd floor. So I don't know where this might have gone. To be honest,
Yeah.
just to point that out.
Yeah.
well, the reason why the letter was written to Sarah is that when the check came in, it showed that Sarah's signature was on it, and the return address on the check is the one that's on this letter. Okay, so we just simply, we just use the,
So anyway, I just wanted to clarify.
yeah, so we use the address that the city provided on the check.
Okay.
At any rate, the additional COLA scenario was the 2.25%, and this report really should be read with the April report that the board received, previously, that had the other COLA scenarios. And the cost for a 2.25% COLA, as one would expect, fell right in between the 2% COLA and the 2.5% COLA. And just for a little trip down memory lane real quick, if we want, the April report showed that we had cost ranges anywhere from 29.90 with no COLA to 35.45% with a 3% COLA, and that's with a 15-year amortization. And that compares with 33.82 on the July letter that you see. and then using a 25-year amortization schedule with a no COLA all the way up to a 3% COLA. The range for cost was 30.07%. Correction, it was 26.14% up to 30.07%. And then on the July levy, you'll see the 2.25% COLA fell right in between, and that was at 28.92%. So that, I'm not really sure that, I don't think anybody's probably surprised by the result. We would expect it to be right there, you know, in that range, but this actually tells you what the cost is as opposed to what we might think the cost would be.
Well, and part of the impetus behind going ahead and requesting it is that gave us more options and didn't delay anything if we needed to consider other options. We didn't want to delay the potential. So we don't have to get that at the city's expense.
So just going through here, the, is that page 3? It lists the both the 15-year amortization period as well as the 25.
Uh-huh.
I don't really understand that the caption below that, the prime rates above, different lot, et cetera, it goes on, says plan shown on the following pages are 16.78 and 11.88, 15 versus 25. Is that the cap rate?
Yeah, this little footnote, the asterisk that is being referred to on page 3 under the kind of the box that shows you the rates for the two.
I'm sorry to interrupt you, but could we wait till Charity?
Oh, absolutely.
It's rated payroll is what they're talking about. I think that's the rate charged against the payroll, is that correct?
It is, yes.
Okay.
The ultimate will be charged against payroll, yes.
So like on your last report, on the 2% page, if you got that with you, which was page 5, it shows the 15-year would have been 16.28% of payroll, and the 25-year amortization is 11.52% payroll.
Are you on the his report?
I'm on the Gabrielle Roder-Smith report that they gave us last month to compare like the 2% to the 2.5, or the 2.25 that they're showing here.
Well, what, if I may, what impact would that have, say, looking over on page 4, projected unfunded accrued liability payments over the years, going down through the years 2014. You don't
Well,
mind explaining that?
Certainly, kind of,
What page again?
we're on pages 3 and 4 of the July 12th letter. Is where we started at, Mr. Moore, was the, under the box in the center of page 3, the little asterisk, the small script, talks about capped and uncapped rates, and then we tie that into the discussion about what the schedule is showing on page 4. One thing that the actuaries did, and this was something that I probably didn't explain clear enough on the April letter, is that it had the same caption that you see on page 3 with that small text about the capped rate and uncapped rate, is that the police rate for Little Rock is currently at what's called cap, is that law does not allow the retirement system to move the lobby-only contribution rate up more than 1% a year, and it's designed that way so that local budgets are not shocked. You know, you don't have a 3% increase in rates because, you know, the law doesn't allow it. And so what happens is that because that capped position of 1% is in law, is that if that was actually removed, the city's true rate would be 17.04% as opposed to 15.23. And so the actuaries are just simply disclosing the fact that what they did is they used the uncapped rate, the 1704, added that to the unfunded accrued liability payment, UAL payment, to produce what the total contribution rate is. So the first year's employer contribution rate is actually slightly overstated from what the system could actually charge the city. So going in, say if you did a consolidation, you went into 2014, you started January 2014 with your first payment to the retirement system under consolidation. The system will actually have to use the UAL payment that's produced on what is now page 4 and add that to the capped rate, which will become 16.23%. So if we take 16.23 and add it to either the 16.78 under the 15-year schedule or the 11.88 on the 25-year schedule, that'll actually give the city what their contribution rate will be. Then they'll say, well, our payroll dollars will be X, and they'll take the rate times the X amount, and that's going to produce the actual total dollar amount of contribution.
Didn't we say though that in order, like in all the analysis Jody did, we're not only going to be paying in what this incremental percentage is, we're gonna be paying in every bit of revenue that's collected, which is in excess of what this is, or it doesn't work out to where, you know,
This
we don't
payment-
end up with big payments at the end.
It goes to pay, you know, future.
Right, right.
So, actually, in effect, the city rate would be lower than what is listed here
Yeah,
on
by
page 4.
about 8.81%, that's true, is what the first year's contribution rate will be. We have to remember that subsequent years, you know, there will be another 1% increase. However, we're also coming up to 2016, where there's gonna be the single rate. So there is the possibility that depending on where the system ends up at totally in 2016 for the statewide rate, which we expect to be around 19 or 20% of payroll, it may actually be a little bit less on most recent projections, is that actually could turn out to be a benefit for the city. Because the city's currently at an uncapped rate of 1704, and then we know that there'll be another percent increase, that's 1804, another percent increase is 1904. You know, that takes us to right on top of 2016. So I don't know that we're gonna have a huge disconnect by the time we get to the single rate. But right now, what I wanna make sure that everybody understands is that these rates that we're showing you are really what would be the worst case scenario if the system was not bound by state law with that 1% cap in rates.
And these are the payments, the rate shown is the rate in addition to whatever we're paying
For a lot.
for lot fee?
Yes, ma'am.
Okay.
You bet.
That is the worst case scenario.
Yes, that's exactly right.
That's what we're using in the
Right. Yeah, that's what
Well,
the actuaries
okay,
did.
but this report doesn't show what we're paying to lot fee. That continues to move at 1% of what, this shows what we would be paying just for this plan.
Right, yeah, you take that plus your lot fee rate,
Right.
which would be the 16.23 number
Right,
we're talking about.
right. But the rates here are not going to be less. They would be, but now they would be adjusted annually based on the earnings, right?
Well, correct, they will be adjusted on earnings, but the factors are already taken into account, any adjustments just for the local plan portion.
Right.
But you're hitting the nail on the head in that we have to recognize that the lot fee only rate will adjust. We expect those adjustments are not gonna be the full 1% for the city of Little Rock, though, when we get about 2 years out, just because we're gonna be on top of that single rate for all locations.
Right. But I think all of Jody's analysis was just looking at this. You know, what we were gonna have to do to meet this with our existing inflows of funds. I mean, now look,
But he says these are using the worst case scenario on this report, is that right?
Yeah, the actuaries, they're using Lofty's assumptions, you know, 8% return, 4% wage inflation, and looking at the fact of, you know, where the market value of assets are at right now, as of 2012, December 31, 2012, and then projecting out either 15 or 25 years.
right, but if the lot fee rates are less than 8%, then this rate goes up.
The Lofty
If
rate
the-
will definitely go up, yes.
Right, this rate will go up. If the lot fee rate of return is more, then that could potentially go down. So when he says this is worst case, it's not necessarily worst case, because if the rate does not, if the rate of return does not stay at least an average of 8%, this could go up, correct?
Yeah, I think that where the worst case statement was coming from was the fact of using the uncapped rate, is that those rates are picking up the uncapped rate, which is clearly higher than what the system can charge, you know, at this point in time.
But you're saying if it falls below 8%, it could be problems, what you're saying. But the actual lofty rate of return since 1983 has been 10.12%.
Good
That's
memory.
right.
Yes.
Yeah.
Yeah.
Well, and still the fact, unless I'm missing something, the fact still remains that this is using uncapped rates when indeed, by law, there are capped rates that apply.
That is right.
So, which in effect, under any circumstances, makes it higher for that one reason alone.
That's right. So we need to look at your computer rates and just take 0.81% off of the total stated rate. And then whatever your payroll dollars are, Sarah, you know, whatever that happens to be, then that would be what you would want to allocate for employer contributions.
But how does that affect the fact that, I mean, we're gonna pay whatever you tell us is the base for lot fee, like we always have. Capped or uncapped, that's already in our budget. I mean, we know it's not gonna go up more than 1%, and we pay that rate that you bill us. These rates on the 25-year amortization, which is the only one we can afford to look at, do not exceed the cap, right?
Yeah, those are not even looking at the cap, because the
Right.
cap, this is what applies to your lot fee rate.
Right,
You know, this
doesn't
is
apply
only-
to this.
This is only looking at your local plan.
And what we have said is, whatever revenue is collected, regardless of whether it's only, let's say in the 2.25, 11.88% of payroll, it might actually, the revenue might be 12 or 13% of payroll in that first year. Whatever it is, we've said we have to contribute in order to not end up with the big extra payments that happen towards the end of the schedule, and looking at our annual revenues that come in order to make this something the city can afford. So I guess I'm just confused as to how that really impacts this decision, the cap that we're talking about, how that really impacts this decision.
Well, I think how, I'm not sure that it necessarily impacts the decision about consolidation. What I want to make sure that everybody's clear about is that whenever you get into the budgeting aspect, and the ultimate, it's gonna be X millions of dollars, is that you have to look at if the first year rate is already overstated slightly, that you really need to back that down by 0.81%. And then that's really what would be needed to be budgeted. And so the next year, you know, we'll go up 1% of rates, so the 16.23 that I mentioned earlier for 2014 should become 17.23 for 2015. Okay, so, and we're saying right now the report's using 17.04. So see, we're already using pretty close to what's gonna be projected for 2015 costs in this report.
Well, and that, but realistically for budgeting, I would have said, I would have taken the 16.23 that you give me, and I would either have added 11.88 if we're at 2.25, I would add 11.52 if we're at 2.0, or I would add, you know, whatever this other rate is for 12.25 if we're at 2.5. And that's gonna be my contribution.
That is correct.
Okay,
Yep.
and that's how we do it.
What we don't, I mean, what we don't have is a chart like this
Right.
that, I sort of expected that, but, I guess.
That's what Jody does, not what
Right.
Gabriel Rover does.
But I think I need to see that in this format too. I think this is a document that I think is easily, you know, explained and looked at. And so I'm gonna go ahead and order one of those, I guess.
How long do you think that would take, Joey, to complete something like that?
I don't think it'll take him any time, except that he's got a wedding, I think, this weekend, so I'm not sure that he's in the office, but I bet that, Lawrence can probably
I think
do
it's
it.
just
Yeah.
plugging in the number.
We can't, Lawrence, and out on your staff,
No, Lawrence on Jody's
Jody's
staff.
okay, your staff, since you've got the numbers, can't just make the chart?
No.
It's an actuarial thing, that's above my,
Well, this was done by actually.
Yeah, but yes, it was done by Jody's office, yes.
this
No,
one
no.
wasn't,
No,
this
this
is
one
done.
Well, this one was done by.
Can your office make it into a graph?
Well, this information can't be put into the format that Mr. Moore's talking about, because it's actually using different information. It's talking about revenue inflows. This is actually talking about costs. That'll actually come out.
Yeah,
Yeah,
it's
so
just
we
talks about
can-
cost. Jody's takes our revenue.
And again, I apologize. If I'd have known we'd gotten this last week, I would have went on and ordered this, and I obviously you can see we all just got it, so.
Can we, as soon as we get that, can we call a meeting and meet, since time is kind of short?
And let me, just on the timing standpoint, because I want to, David, in looking at this, you all need everything by October 31st?
Yes, the documents that were sent with the April letter, yes.
So I mean, I'm not sure, I mean, we've got, you know, the city board meets 2 times in August, 2 times in September, 2 times in, I mean, I think we've got ample time. It's my only, and I'm gonna be out the first 2 weeks of August, so.
But I think the thing was to take it to the membership.
On the 13th.
Uh-huh.
Of what?
August.
Yeah.
We've scheduled the only time we can schedule a membership meeting and training, which everybody can part and get into, is August the 13th at 10 o'clock. And because they have a rookie school going on, and that's the only day available. And I've worked with them, with Captain Captain Temple and Chief Thomas.
And I mean, I'll talk to the chief, I think, you know, getting a date in September wouldn't be a big issue. I mean, if it is, let me know, I don't mind talking to them. I'm glad we got a class going, but we can accommodate.
Let me ask this now, I'm just trying to make sure that I understand it. What you're requesting, Mr. Chairman, is to take this information provided by Lofty Actuaries, which, is it correct to say, does not include recurring revenues?
It doesn't take the cost and
And-
method of the insurance.
Yeah, and to incorporate the cost in with.
Correct.
So that I'll understand what you've got here, if I may. For example, the first year you have 4.00. What does 4.00 represent? That's on, I'm sorry, that's on page 14.
It's on page
Four, page 4 of your report.
Of the July report.
On the 25-year schedule.
Well, that's $4 million
Okay,
on the
4
far
million.
right.
But you said that actually because they use the uncapped rate, then that needs to be reduced by 0.81%.
Okay, that's a good question. No, this number here on this page here is exactly as stated. It would be the Lofty only cost, yeah.
I got you. Okay, so, our reoccurring revenues, just to sort of get in the ballpark, our reoccurring revenues currently are what, what million? Roughly.
6.5. Look at my financial report attached to today.
All
Well,
right, 6.1.
6.1 on the
Yeah.
2.5, I'm looking at.
Well, just on the income stream.
Yeah,
6.1.
6.1.
Okay.
But that's what Jody calculated in here as far as Sarah was saying, rolling that back over into the future notes, and that's what brought it all down to zero.
right, that's why we have to do, that's what I was saying, instead of just the 4 million that this would call for, we would have to contribute the entire 6.1 in order to, that's all of his assumptions assume we contribute everything, all of Jody's, that we
Right.
contribute
We don't-
everything.
we're
that
not paying the
comes
minimum,
We're not
we're
just
paying-
paying 4 million.
Right.
But I'm looking at, on the 2.5 page here, at year 25, it's 6.9 million revenue. And then for the report David provided on year 25, it's 10.24 million revenue.
Where does he have revenue on
He
David?
didn't have any.
He
this
doesn't
is
have,
not-
that's the
this is revenue.
expense.
Oh, expense, okay.
All his is.
That's why we need to get this, we need to get this incorporated into the revenue piece,
Well, yeah.
just to, so
Because
we're
that's what I-
comparing apples to apples.
But we'll go back to the repair said that 4.0, that's a million, isn't it? That's what you're talking about?
Right.
That's the
Yeah.
cost? Okay. And
Well-
that's not the revenue though, but the revenue. that's
Well,
not-
and see, if we only paid that 4 million, Jody's showing in year 25, our revenue would be 6.9, but our expense here would be 10.24, so there's a difference of 3.3 million
But you got all
more.
the-
But the only way that that doesn't happen to us is if we make excess payments in these first years to pay down that liability faster.
So the really only way to understand it, like Mr. Morris
Right.
said, is
Right.
in these charts here.
Well, let me ask you, if I may, in the last meeting, the information reports provided by Jody indicated that on a 25-year amortization at a 2.5% COLA, it would result in no additional cost to the city.
With the caveat being that there's never a year that there's less than 8% return. That's correct, I mean, that's, so we can get it all reflected, that's correct.
Even though
Well-
it's 10.12.
Well, and that the additional allocation continues to come in, which is another concern. You know, I mean, there are variations, and it also assumes 3% a year growth in our property tax revenues, which this year are 1.19%. So, I mean, those are concerns, that if there's any variation in the revenue assumptions, this doesn't work.
One question I have.
But he said, I wanted to let him finish this.
Well, two issues. based on what Sarah just said, I guess. First of all, you said that, Mr. Chairman, that it's presuming that there's never a return less than 8%, is that correct? I thought it was presuming that that was an average return, not that you wouldn't have a single year that was 7.9, for example, or a year that was 10. I mean, isn't that correct? I mean, it's crazy to assume, in my view, that each and every year you're going to absolutely have 8% return. That's just not going to occur. Years are going to be above, years are going to be below. We can look back historically and see what they have been over a period of time. Nevertheless, we all know that the rates go up and rates go down. So I can't imagine that report not assuming that there will be years down, there will be years up, and I thought was under the impression that that was an assumed overall rate. Is that not correct?
I believe what he said is he did use the average
I think he
8%.
did.
He said if there was he was concerned that if we suffered any kind of an event like we've experienced twice now in the last 10 years, I think, with a sharp drop in the market in these early years, that this does not work out.
Well, but now that, what you just said is different than what was said just a minute ago, drastically different, because indeed, I think what that report is doing is assuming an average, quote unquote, average rate of return. It's not saying that the rate won't drop below 8%, because we know in fact that it will. Now,
But can if I could just, and I know this is a lot more complicated than you all want it, but I don't want you to miss what Sarah just said about our property tax, because that has an impact on everybody's budget, not but my $223 million budget. And this is projecting 3% growth, and we just got our numbers in. It was what was it?
1.19.
So, we're already off if that was, in this calculation. So there are a lot of factors that we're trying to work our way through, not just the lottery return. I mean, y'all got that paid. I mean, the only thing that's really set is our sales tax contribution, and then the other things are kind of, we just don't know, So anyway, I didn't want to lose that point about factored in our numbers was that 3% growth when we just got our number, and it was a little under 2.
Mr. Chairman, I mean, in that regard there, I would have to remind you that now, this one single year, I'm sure you're correct, that it was 1 point something growth in property tax revenues in the county. But if you look back historically, that goes to the difference between an average and it dropping any single year.
I remember their cap though.
Well, and because our growth was at a slower rate instead of a 3-year reassessment.
But you're talking about for
doing a
1 year.
5-year. Well, no, this is the point I'm trying to make. In the past, there is a cap as to how much your property taxes can grow. So in years when values were growing quickly, that kind of slowed the effect for the taxpayer. It also slowed the growth for the city. But what happened then is when we saw the big declines like that happened across the company, ours didn't decline as rapidly because we had those caps in place. But at this last reassessment, they used to assess every 3 years because our growth was such that a 3-year assessment was necessary. Our growth was so flat that they're now not going to reassess for 5 years. So the most growth we'll see will be at that cap rate. Even if things took off and property values soar, our revenues are going to be slowed by that increase in by the limitation of the cap until the next 5-year assessment.
Isn't it capped at 5?
It's well, what is it, for businesses,
It's 5 residential, 10 businesses, but I think you're just and I don't wanna get too far off course, but I think you might be off just a little bit. I don't believe that the reason they are moving from a 3 to 5 year assessment is because of a reduction in the growth of tax revenues. I think it's probably more so because of the cost of reassessing
No,
3
they
years
absolutely
versus
said
5.
it was the rate of growth, that is the reason.
Well, there's been a lot of public pressure to
Because,
raise it to
well, but-
5%.
Well, but other
5 years
areas,
rather than
other
3.
areas of the state that would have faster growth are still on the 3 year cycle. It's our area that's not.
Well, and there's been others, I know there's the examples, it varies from state to state, but irregardless whether it's 3 years or 5 years, the residential's capped at 5% per year, and the investment property is capped at 10. So, I don't know what impact really that's going to have. Points taken.
I have a question about Joey's last report. When I got time taken home and really looked it over, the 2.5%, first 2.5%, he said it wouldn't have any impact on the city at all. And then you flip over to his last 2.5% where he's got the yellow line on year 3. And after listening to the tape over a little bit, he claims that he had just picked one year out of the 25 and just threw a dart at it to hit on year 3. Well, when it hit on year 3, he raised the liability several million, and that kicked everything outside of whack going down from 3 to 25 years. Why didn't that dart hit on like year 22? That wouldn't have had an effect or something. I don't like this report, and when we order another one from him, I just like this report, his original 2.5 back there, but here's the facts. Now, he's going into what if on this last 2.5 and throwing the dart, and threw the dart and hit year 3. Well, if he threw the dart, why not just hit year 22, and then we wouldn't have this problem? So I don't like this at all. And if we get another report from him, I don't want to see that in there. I just want to see the facts.
Well, it's not a fair representation.
It's not fair.
Well,
No.
but,
That is
none of this, I mean, all of this has to include assumptions, and that's why he was trying to show if there's any variation
Yeah.
in the assumptions in the first part, that's when you have the problem. If the variation doesn't happen till year 23, well, sure, you don't have a problem, because
Yeah.
you've already paid all your
No,
bills.
That's right, the only problem. Why didn't he
But-
pick year 3? Because he knew it.
Yeah, but you've gotta bet the bank that
No.
you're not gonna have any kind of a problem
Gotcha.
for 25 years.
Assumptions are already integrated into the report in your first pages without going to an absurd, and that's my word, an absurd assumption like he used on the last page. There's assumptions used on every page of that, isn't there?
Yeah.
Why throw out an absolutely absurd assumption in his terms, throwing a dart, and doggone it, that dart hit the 3rd year.
I mean, I think, in fairness to him, I think, he does need to show, if this, we're all hoping and praying, and I definitely am, that, we don't have any more major hiccups, but we don't know. And so, I don't think it would, I think it's prudent to look at all the options, and I think that's the best way to include it, so.
Well,
Mr.
hit the
Moore,
dart
I
on
just
year
think it's the
23.
opinion of this board that there's some bias in Jody's report, and we've talked about it privately, and, it's just everybody's opinion that there is some bias there. I don't know what the underlying cause is, but for him to take year 3, it's just not right. It's just, I know things happen, but that's just not fair.
Well, I just wanna say, because I don't know where the assumption of bias is coming from, but we did not in any way, we being me, the city, in any way, direct him to do anything like that, to throw any kind of darts. We didn't see the reports 1 minute before y'all saw the reports. I mean, there absolutely was no intervention on our part in any way.
I didn't think,
Trying that.
yeah, I
No,
didn't take it
that's not
that
what-
way.
That's not what I'm saying.
Yeah, okay. All right, anything else on this subject? We'll
Yes.
order, go ahead.
What are we looking at now? Let's go over this, because tentatively, there is we are reserved. Mr. Chairman, I know you're the city manager, you can pull the strings on the training building, but what are we looking at?
Well, I don't think we're gonna, you know, if you all wanna have it, if it's already scheduled and y'all got something out to your members.
No, we don't.
Okay, well, I was gonna say y'all go ahead and have it and kind of tell them what's going on, but if you don't, then I would just, schedule it, try to schedule it for after our next meeting or, you know, in September.
One, if I may, one suggestion I would make when you do meet with your members, I would try to get them.
Well, you're gonna be there too, though.
Okay, well, depending on when you set the date, you hadn't checked with me, but.
Well, we don't
but no,
know
okay.
because.
Yeah, I know, but all I'm saying is, I think it would be wise when you're getting their consensus to get them to agree to a range, whatever that might be, and not lock in on one number only. And the only reason I say that is, when it gets to the city board for approval, we don't know what they might say, and I would hate to think that you have to go back to the drawing board if they were to come in and say, let's say you've got, you know, 2 on the board that advocate one, and another one comes in and says, well, what about this? And they all decide on something a little bit different, just slightly different than what you've gotten your membership to agree to. I'm just concerned about having to go back to them or not be able to consolidate it all. That's just
Well,
mine.
Why, you may, okay, I mean, you may be right, but along those same lines, if you will, and I hope that as we're waiting for September and considering, yes, these various things, how this is proposed and laid out for the membership matters. And when we engage in a 1 to 2 year process, and finally come down through a series of different changes that's made from the state level all the way down to the amortization period. And the actuary comes back and says in a report that yes, you can consolidate with a 2.5% COLA with no additional cost to the city. It's hard to go to the membership and explain that to them, that there would be no additional cost to the city, but hey, we've got a deal for you. Instead of a 2.5, we're gonna get you a 2 or 2.25. It's a hard sell under those circumstances. And
Ferris, the only thing I would say to that is, when I take this to the board, I have to be able to have confidence in that, and that's saying that, and at this point, I'm not there. So, and so I'm trying to get somewhere, but I'm not there at this point. So, I think what Sarah's saying, and I might not agree with saying a range, you know, hopefully we can get to a point where we, agree on a percentage, and that's what you take. That's my goal. So. Anything else on this one? All right, we'll be back on for, and we'll go ahead and, Sarah's, let's go ahead and order the report from Jody. And
We're pinning it down, Bruce, to go to the board, the second meeting of September, it looks like, to make sure, you know, that they don't want you, is this a legal thing that has to be read 3 different meetings?
It'd be an ordinance to consolidate, but I mean, it just has to be read 3 times, you know, it doesn't have to be at separate meetings.
Okay, so then we're talking about the second meeting of September. So the meeting with the membership would have to be between this board's meeting and the second meeting in September, and I don't think there's any time there out on my calendar now. But this board meets the 3rd week of the month, right?
Third Thursday.
And the 3rd Tuesday is when the board meets. So are we asking the board to do it before we take it to the membership? And I don't think that's right.
No, I don't, no, but again, Rick, we've got till October 31st. So even if we were acting on it at the first meeting in October, you know, we still have a month to, so we would put it on the agenda. This works in my mind, worst case scenario, that we're doing this at the last agenda meeting, which is September 24th. And for, you know, board action the first meeting in October. So, yeah, I think we've got some flexibility. And I think if we all are going on the same page going to the board, that's gonna help a whole lot, you know.
Okay, so the 24th of September would be when it would be on the agenda for the first meeting in October.
Right,
And that would still give you plenty of time.
right.
They'll
If
give
we
the
had
city.
you at least 2 weeks before the end of October.
They said October 31st.
Right, October 31st for the city to get all the documents that we need, which was with the April letter. Yes,
And
ma'am.
once the board passes the consolidation agreement, then we sign the documents and send them over.
Okay, and so our meeting with the membership would need to be
In September.
in September, but probably prior to this meeting. Of course, we could always move this meeting up for 1 week.
We can be flexible on that.
That'd be fine, fine with me, on everybody else.
In fact, it would benefit me if we could move it up to the second.
September.
Yes, but, no, I'm thinking, it's disregard. It doesn't matter.
We will be as flexible as we need to be on the schedule. If we need to have call meetings or something, I'm open to that.
Okay.
I just don't want to go to the board before we take it to the membership.
Oh, I
because
agree.
want the membership to feel like that they're having a say in this.
No, I agree with that.
I just go back to what I said a while ago. Y'all said you didn't ask Jody to do this last 2.5 of this DART situation. Can we just get the facts and leave the DART out? But that's really confusing.
But just, let me just say, and I think it's important from a professional standpoint, that we don't direct Jody either way. I mean, I'm ordering this study, and I expect, we'll have whatever he presents. I'm not gonna direct him to do this or that. He knows what, we're gonna give him this information and ask him to submit this scenario back to us.
But Mr. Chairman, that, sir, is our concern, to be quite honest with you, is, you know, he could throw good darts, and he could throw bad darts, but it just seems like he's always, when it's using conservative estimates to start with, and then he throws this poison dart, but he doesn't throw any good darts. And the poison dart ironically hits at the heart to kill. So I think that's Lee's point.
That's my point.
Valid point.
He don't throw a dart, throw a good dart.
Yeah, throw a good dart.
But it's
I
hard
know
to,
there
it's
was
hard
good
to,
darts.
it's hard to look over when he throws bad darts.
The one with a
Okay.
little suction cup on.
Yeah.
It won't hurt.
All right, next, report from Sarah.
Okay, FA minutes.
Yeah, thank you.
Okay, on the front page of your June balance sheet, you'll see, and this matches the Stevens
How many
report.
pages back is that?
It's right behind the minutes.
Okay.
Okay. Everybody got it? Okay. The fair market value of the, plan assets was 43,358,610. 42,685,209 of that was managed by Stevens. The drop balance that's presented is still the May balance. They were trying to get the drop database closed with the posted earnings and all of that, and so we weren't able to get the updated balance. On the next page, you'll see the, sales tax contribution. There actually was a duplicate sales tax contribution made in the month of June, and that'll be offset in the month of July. It had to do with changing the people that were making the transfers. They have a recurring setup, and this one got doubled, but it'll be corrected next month.
Did they actually pay us too
They
much?
they actually transferred it twice in 1 month, so next month they will not transfer and we'll be back on track. So you got it early. The property tax contribution was $96,269,000 for the month, so we've collected, about, 1.6 million. The remainder, the big deposit will come in at the end of the year in the November timeframe. we, let's see here. Okay, benefit payments were, just under 600,000 for the month, so just about 3.5 million year to date. If you go down to line 35, you'll see the drop payments were 508,529 during the month, and 919 in drop. 919,000 has been withdrawn in drop year to date. So the net expense before investment earnings was 895,351, and year to date that's 2,398,720. We did have net investment loss in the month of June, 382,724. The loss during the month with the benefit payments and the negative investment returns was 1,278,000. Year to date, the fund is down 242,841. But the investment returns have been positive 2.1 million, so it's just where the benefit payments are still exceeding our revenue. And again, the property tax comes in towards the end of the year, so with the positive investment returns, that should be turned around. On the next page, you see the expense report for the month of July, and here it's just, or it's presented in July's for the month of June. It's just the monthly meeting fees, the monthly lobbyist, and that's.
No attorney fees
No attorney
for
fees
you.
still.
I have a question. When this is put in July and everything, will there be any monthly fees?
We'll have, our share of the investment manager is included in the rate, but there won't be any, they won't get $150 for the meeting or anything like that.
But there won't be any postage, there won't be any.
No, and that's not, we've talked about this before, the studies that Jody prepares for us do not include any expenses other than benefits, nothing but straight benefits.
Just straight benefits.
Straight benefits.
That's what his report's already in.
Yeah, it's just benefits.
Sarah, just a quick question, does it include the death benefit? The 6,500 that?
Yeah, all the benefits that we have under our current plan carry over to the other plan.
But is that included in Jody's assumptions
I
on
would
there?
imagine it is.
I just
Oh,
thought
he
of
didn't
that
leave it out,
when we.
I'm sure he's looking at benefits.
Yes.
Just benefits. And the rate of return assumption is the net rate of return, so it's already net of any kind of investment manager fees. So that's the only expense, that you would have is investment
Right.
management fees.
Are we still looking at August for the members to receive their?
We got the payments in, we balanced, the police amounts that will have to go out. We have to do it, you have to run the pension payment first, then you have to activate the people who are on continued employment because they don't receive monthly benefits, but they will get these disbursements. Then we run these payments and we have to deactivate them and ready for the next monthly pension roll. So we are in the process right now. She got the payroll done yesterday.
Payroll finished yesterday, of course y'all get it tomorrow, so we hope to start running these payments next
We wanna
week.
get this done before the August benefit payments.
Talking about
So,
Can y'all
Police
let me know,
supplement.
Debbie, in an email so I can send you it out to everybody? Thanks.
we're coordinating with Peggy because the other thing, and Peggy's our programmer, the other thing that had to happen was posting the interest earnings to the drop. So she had to post a drop database to get all the earnings posted before we can run anything else, so.
The good questions. The police supplement, when do you think they will be going out?
Well, that's what we were saying. Our objective is to get it done before the end of July.
For
Okay.
the end of July.
Mhm. Yeah.
And the second one was the drop interest earnings.
Statements.
Yes.
She's working on
We
that
have the
right
certified rate.
We did get the certified rate, and, did we not communicate what that was? Well, I think it was 10.09% that you earned for the year, and then you subtract 2%, so it's 8.09, I believe
It
is
was
the.
close to 8.5. Was it
That might have
11
been
minus a half a
One of them was a little bit more.
Well, no, I think,
That's not adjusted.
well, can you go get that letter? go get that letter and we'll send you, because the one that, what you're thinking of is the Stevens before they back up their fees, and it's the net.
Yeah, this net, there was 11, then the Stevens fee's about 10.5, and we got 2, that's around
I
8.5.
don't, I don't think it's 8.5, I think it's 10.
Close to, it was under 8.5,
Do you
but
have
close to
that
8.5.
schedule?
Yeah, but I believe that was
Schedule from Jody, if I can look at that, I can.
pre-fees.
The schedule.
The
That
historic.
was Larry's
schedule.
numbers, wasn't
If I can just look at the
Oh.
front page of that, yeah. Yeah, I was correct, it was, for 2012, it was 10.09% was the market rate of return, you subtract 2, so it's 8.09%.
8.09, 8.09.
8.09. Fires was slightly higher,
Yes.
very slightly.
it? So, those statements were
Yeah,
good.
Trish. Smart. I make a motion to approve the financial statement.
Been moved and properly second. Any further discussion? All those in favor, signify by aye.
Aye.
Opposed?
Mr. Chairman, I'll make a motion to remove Mr. Harold's book from the pension rolls and to extend our board's sincere condolences to his family and to approve the $6,500 death benefit.
I'll second.
Moved and properly second. Any further discussion? All those in favor, signify by aye.
Aye.
Opposed? Joe, was that name sounds familiar.
Harold Zook was the Chiefle neighborhood
Yeah.
president back in the 90s.
Yeah.
So minimum standards for years after retiring.
Chief of Police, you read along?
Yes, sir.
Real long standing law enforcement.
He
I
was
knew that
very
name.
active in the
He
neighborhood
was, yeah.
movement in the 90s in Southwest Oklahoma.
Wonderful guy.
And then Dean Garrett did make her payment.
Okay. Don't see any additional members here. Is there any other business?
I move we adjourn.
I'll second.
Moved and properly second. All those in favor, signify by aye.
Aye.
Opposed?